We are back in the black hole of real estate, and I get some questions about a topic where it's not talked about a lot, but it's actually used a lot. It's buy and hold for real estate investment. This is your host, Ron Wysokarski, for the black hole of real estate. And quite often, people will buy properties as investments and hold them for a couple of reasons. One, some monthly cash flow, but two, upwards appreciation. And we think so much about the short-term rentals, which, they're sexy, they're sensational, they're supposed to bring in a lot of cash flow. And then the ones where you buy them and you flip them and you make a bunch of money, that instant gratification for each of them with exponential returns. And they absolutely are popular. But if you think about it, most often properties are bought as an investment over time to hold on to them. And when you start to measure things, you ask yourself, if I bought it for cash and I paid $200,000 for it and I get about $2,000 in rent, that ratio, that 1% rule, super good. I don't know if those 1% rule holds as much as it might have in a different time. And I think a lot of times it might be more like 0.8%. So if you purchase at $200, you can rent for $1,600. I see a lot of that happening. But your cash-on-cash return on investment for many people is really good in that area. Because on the other side of that, you also have upwards appreciation in most cases for these properties. And if a savvy investor is buying them right, the property they buy at $200 this year, it could be $203, $206, $210 next year. So maybe they're making some money every month. And if they're financed it, that's a little bit different. If you have a mortgage on the property, maybe putting 20% down, maybe your return on investment as far as the amount of cash every month in your pocket might seem smaller, but by leveraging your money, you could get it to 4 or 5 properties for the same amount of money. So what I mean by that is if you pay $200,000 for one property and you're getting $1,600 to $2,000 back, that's absolutely the way to do it. But what if you invested the same $200,000 and you bought all $200,000 properties, but with 20% down? So 20% down is $40,000, and at $200,000 you can buy 5 of those. So maybe making $300-ish per property is the same as making $1,500-$1,600. But you could, in theory, have five properties appreciating at the same time, and then the upward gain might be different. If they all, let's just say they all went from $200 to $206, they all went up $6,000 each. So that's $30,000 in the equity category, and that's going to compound over time. And I'm not here to decide the battle of, do I own them for cash? So it's straight to pocket return for me, maximizing my opportunity and reduce the amount of work to one property, one set of repairs. Or are we going to go and maximize that and get 5 properties, all appreciating? Because on a good year, if the market goes up 5%, 200 to 210 is 50. And the next year, another 5%. Well, that keeps, as the price of the property goes higher, those increases become more. And over time, you can also increase the rent, and the returns should get better year after year after year. Now, I would factor in there's going to be some vacancy. There's absolutely going to be some increase in taxes and insurance. That's just life. But as the pie gets bigger, the pieces within that, there should be more profit at the end if you're doing it right and you're buying smartly, regardless of the market conditions. What we're finding is when someone is purchasing in the buy and hold, they also have the hidden gem that nobody ever thinks about, and that's the depreciation. So, get with your CPA. That's not my job. I'm not your CPA. But the depreciation every year is going to help you out at tax time. And the only time that it's going to change for you is way down the road when you go to sell it. You're going to have to, what they do, recapture that depreciation. You'll pay it at the closing table because you've depreciated the asset. It'll be more of it will be taxable. Your cost basis will change over time. And as you take all the depreciation, you'll owe some more taxes at the end than if you didn't depreciate. But, we still have that 1031 exchange that we've been talking about, where you can defer the taxes into the future. So you would want to talk if you're going to move a property, you would likely do a 1031 exchange and buy more real estate, and you'd be faced with the same situation. Are we buying a multitude of properties, or what type of properties, or the same ones? So having a good CPA, having a 1031 exchange person that you can work with and discuss the scenarios that are going to make financial sense for you, here, today, tomorrow, whether it's benefiting you in this tax season or a future tax season. This is the strategy session that needs to take place. This is what happens when you properly plan your profits, whether you're selling something at a gain or selling something at a loss to offset some tax advantage, or just to continue to buy and hold more. But if you think about it, you rarely hear people talking about, I want to buy it and just hold on to it. And maybe it's just this Amazon microwave fast society where we want to buy it, make a bunch of money on it, and all happen in 24 minutes. We want to buy a property and it wanted to close, by the end of the day, or delivery tomorrow. I want my closing documents delivered tomorrow, because we've been conditioned that that's an acceptable thing, is to push the button if things show up. The investments over time. And I would say the same thing with the stock market. A lot of people do, they will buy and hold for the dividends and appreciation over time and building out a portfolio versus day trading. Flipping is day trading, right? And the short-term rental market, well, maybe that's a fund that I'm not too aware of, but I think you see the similarities right now. Oddly enough, for all the sizzle of flipping and short-term rentals, most people end up with a buy and hold strategy. They buy it, they hold on to it for many, many years. Sometimes it's to sell down the road. Sometimes they're pre-buying a retirement home on today's prices and today's terms, while they have a sizable income, which may be different in retirement. And acquiring those properties right now, and perhaps they have a primary residence in a different state and a vacation property in Florida that's a rental that will eventually be their primary residence. You see, now they've got two properties appreciating, and they've got depreciation across these. There's a lot of benefits and strategies that wouldn't necessarily meet the eye in the beginning, but now that we're talking about it, there are a ton of benefits to buy and hold. It's tried and true. It's the steady Eddie way of doing it. And the results over time could actually outperform some of the other strategies. A flip, it's finite. You're going to buy it, you're going to sell it, have some money, and start over again. So there'll be gaps in that. And in the short-term rentals, if there's a change in travel or a change in the types of property people are vacationing with, or maybe the hotels and resorts, are competing hard. Could be changes in municipalities and the codes where you may or may not be able to continue to do short-term rentals, or registrations start eating into your profits. New furniture starts to erode profits because things get used up and damaged in those properties just over time, just under normal wear and tear. And buy and hold, you're taking care of the outside of the property, probably the land, probably the exterior paint and the roof and things like that. Big ticket items like HVAC, plumbing and electrical. Beyond that, the tenant's going to pay for all the utilities, the interior upkeep. It's a pretty good trade-off to have somebody, if you have a mortgage, somebody to pay it off. If you pay for cash every month, somebody's replenishing the money you put into the house. That gives you the opportunity to look at other investment opportunities to reallocate that cash into additional types of investment. And I think that once you start in real estate, you tend to stay in real estate. I think the stock people stay in stocks. There are absolutely people that are in both arenas, but as one performs better, the money tends to shift towards it. So it gets really interesting that for as much chatter there is about flipping and short-term rentals, vast majority of people continue to work buy and hold strategies and are getting great results. So I hope this helps you out on your thoughts and planning, whether it's your first investment property or your 10th investment property. And we look forward to giving you more tips on how to make that work for you financially monthly profit, and tax wise. This is your host, Ron Wojciechowski for the Black Hole of Real Estate.